and we'll be starting very, very soon indeed. So bear with me. Okay, that looks better. That looks better. Right, good. Okay, so what we're going to do today is take you through a particular approach to scalping off the daily chart, which sounds like a massive contradiction in terms, but it's all going to be about how we can identify trades, how we can place them, and how we can be in and out of opportunities quickly. That's really what scalping is, a quick, short fire trading strategy to be in and out of the markets, and that's what we're going to be going through. So before we do get started, I'm on GoToWebinar. A lot of you are tuned in on GoToWebinar, but we're also streaming out on YouTube and LinkedIn and goodness knows where else. So just want to make sure the sound's coming through. If you're on GoToWebinar, this is how you can do that. If I can get as many people that are online just typing something into the questions box, that'd be great. Now, if you're on it may look different depending on the type of device you're on. Shouldn't be that complicated really, but if you're on like a tablet or smartphone, it's going to look a little bit like this. See the questions button at the bottom there with a question mark. It might be like that, or a speech bubble, something like that you can hit on. That will then allow you to type something in and enable the keyboard on your device. If you're on a downloaded computer, it might look something like this, which is the GoToWebinar downloaded program on your computer. You hit the orange button here, that then maximizes the control panel out, allowing you to type into the questions box. So if you don't mind, if I get as many people typing hello or hi or something like that, your name, that would be great. Good. Excellent. Good. Lots of yeses coming through. Let's get on with it then, shall we? So, like I said, today I'm going to be taking you through about scalping Forex on the daily charts. A couple of things that are sort of quite important to me. Number one is being on the right time frame. Forex are really good markets. Scalping is something that a lot of people seem to want to do, like to do, and yet actually you probably don't have the time to do. So I'm going to show you how we can take some of those techniques, how we can apply it to something that's more achievable, something that's more accessible, I suppose, and something that we could do from home with a much probably better success and better results. So that's great. Can I get an idea from everybody here? I've just got a little risk warning notice. Want to make sure everyone's okay with it. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. There we go. I'm not going to read the rest of it. So let's get on with it. Do we all know what scalping is? Can you just type yes or no, please, into the questions box? Do you know what scalping is? Please do let me know. Just a quick yes or no is really all that I'm after at this point. That'd be great. Hello, Guy. Hello, Avi. Hello, Sab. Hello, Carl. Peter. George. Margaret. Robert, Jonathan, good. Okay, a few yeses coming through. A few no's as well there for scalping. So those of you that don't know, scalp is usually a term that's used for short-term trading. As Avi says here, short-term trading for a few pips. Absolutely spot on. Couldn't have said it better myself. So usually in a trade for just a couple of minutes and usually just looking to nick a couple of points out of the market. Just very short-term gain, and you're usually trading in quite reasonable size. It might be 20, 50 pounds a point, something like that, and you're looking to get in and out of the market before it kind of even knows you're there. It's like you're raiding the market type of thing. That's scalping. And it's quite popular, but there is time that's required, a lot of concentration required on the markets. And of course, you can't just go into a scalp trade blindly. You've got to make sure that there's a reason why the market's more likely to go up a few ticks or down a few ticks, really as well. So certain strategy obviously required too. Problem with it is it does require a strategy. It requires time. It requires, I think, probably shall we say, a strong sort of appetite to risk. You've got to be quite quick, so you've got to be, got to have some conviction in what you're doing. And these are some of the attributes that some traders, particularly when they're quite newer to things, probably just don't have. Time in particular. So when you're scalping, usually you're trading over a period of time. So you're not just in and out of the markets for 2 minutes, then going away. Usually you're doing it for probably about 2 hours, and it can be a little bit more sort of intensive, if you like. And I'm not saying it's a bad way of trading. What I'm saying is that it's not actually that suitable for a lot of people, because a lot of people don't have that, and so on. Scratching your scalp, yes, well, it probably ends up like that sometimes, doesn't it, Guy? Let's face it. The thing with it, I don't believe it has to be that way. There are certain hallmarks, though, associated with scalping that are extremely attractive. Okay, so a higher frequency of trading opportunities. Okay, so the more trades you have, the more potential you can make. So, for example, if let's say you're doing, let's just keep it simple, a one-to-one reward to risk. Let's say you risk 2% on a trade. The objective is a 2% profit, which means you can make 2% on your account. If you only do one trade in a month, the most you can make is 2%. Okay, that's it, simple enough. The more trades that you place, obviously you need a good strategy, but the more trades you place, the higher the potential to make money as well. Okay, all other things being equal, of course. So if you're trading with something that gives you high frequency, then you've got greater opportunity to profit. Simple, really. Low trade duration. So what you don't want to be doing is getting stuck in trades. So when you're trading, when you're scalping, you're not looking to be in trades for very long. You're looking to be in whilst the market is moving in the direction you want. You don't want to be stuck in the market for too long, because then your capital is stuck in that market as well. And whilst it's stuck there and the market's not moving anywhere, it's being wasted where there are other opportunities you could divert that capital to. So making sure that your capital is nimble is quite important for a trader, and quite important if you're looking to maximize your profit potential. Fewer concurrent positions means the more effective use of margin. Okay, what I mean by that is, let's say you've got £5,000 on your account. I'm not saying you should do this necessarily, but if you've got one position on and you only ever account for having one position on, you can allocate quite a sizable proportion of that account to that one trade. If you're in a position where you might have 10 trades on, then you have to split that £5,000 starting account across the potential for having 10 trades, which means you're allocating £500 of margin to each trade. And the reason you need to do that is because, well, you might only ever have 2 trades on or 3 trades, but you have to be able to put additional trades on when they come. If you're scalping, you're usually trading a fewer number of positions at any one time. And the reason for that is because you're usually in and out of trades quite quickly before a new trade comes about. So what that means is you can typically trade bigger size. If you want to, of course, if you have that attitude to risk, you can typically trade bigger size and make fuller use of the margin that you have on your trading account. The more positions you plan to have open, so in other words, if you're planning that you could have 20 positions open, you have to split your trade size down accordingly. Okay, fine, good. Smaller stops. Usually, if you're trading and scalping, shorter trade durations, you're usually getting smaller stop losses. So tighter stop losses usually mean bigger trade size. We're probably okay with that. If you want to risk 2% of your account on a 100-point stop loss, or 2% of your account on a 50-point stop loss, your trade size on the 50-point stop loss should be bigger. Okay, it will be bigger. It'll be double the size. So you'll be trading £10 a point instead of £5 a point, or £2 instead of £1 a point, and so on. So the smaller the stop, the bigger the stake per point, and the more that pip means to you. Okay, so 100 pip profit at £1 a point is the same as 50 pip profit at £2 a point. They're the same monetary value, but the pip sounds a little bit different, doesn't it? Well, hang on, you've made twice as many pips. Yes, because you've been able to trade twice as big size, and that's because the stop losses are typically smaller. So small stop losses can mean bigger trade size, which can mean that pips are more important than, therefore, more potential for profit too. All of these mean effectively there's a better use of capital. Now, this type of terminology and benefits are associated with day trading, typically. Okay, the problem with day trading is that most of us don't have the time or the inclination to do it, and therefore most people will fail at it. So it doesn't necessarily mean it's the best opportunity or the best strategy for people. That doesn't also mean that you can't have these factors. And what I want to talk to us today about is how we can trade these elements and yet still do it off something like a daily chart. Okay, guys, is this all making sense so far? Give us a quick yes or a no or Y or an N in the questions box. Are you with me? All making sense so far? Please do let me know. It's reasons like these that make short-term day trading more attractive. But it's all a question of whether we can offset that attractiveness with our ability to follow the strategy properly and to be profitable. And in the main, it requires a change in lifestyle, and that is very difficult for most people to do. So you might work towards it in short term, but often what happens is if it requires a change in your lifestyle, usually you end up forcing it into your life rather than absorbing it into your life, and it becomes very, very difficult. The better way to get better results is to absorb trading into your day-to-day life. So have it work around the other things that you are doing, because you probably don't really want to change those. Okay, good. So is day trading the right answer? The question really comes down to is how much time do you want to put into trading? Let me know, A, B, or C. So how much time do you have for trading, or how much time do you want to put into trading? So the idea of looking at your screens, identifying trading opportunities, placing trades, how much time do you actually want to put into trading? And be honest, be honest with yourself, be realistic. Are you talking A, probably 10 to 30 minutes a day? I've got other stuff I want to do, right? Maybe it's a few hours a day. It's B, I'm all right. I've got a bit of time. Or is it C? I've got all day type of thing. I've got nothing else to do. I don't ever want to leave the house. I'm a bit of a hermit. No, it's not that at all. Anyway, I'm insulting people. That's not particularly clever in a live session, is it? But I've got time that I can allocate. I want to treat it like a full-time job, and that's okay too. Okay. So what would it be? Where would you be? A few hours a day. Let's B. You could day trade on that. 6 hours a day, you can day trade on that as well. Okay, these are day trading opportunity times. So you would have the time and you would have the inclination to day trade, which is short term, being in and out of the same trade within the same day. The vast majority of people, though, here are actually selecting A, and that's normal. This is typical. This is where I sit most of the time. Is that I'm typically happy to trade for 20 minutes, half an hour a day, because I've got other stuff I need to do. So the question is, can we apply these benefits, if you like, into trading for 10 to 30 minutes a day? The answer is yes, and I'm going to go through that with you now. Okay, it doesn't have to be day trading to get the advantages of scalping. We can be end of day trading as well. Okay, so let's have a little look at it. Here's just some. This is a little while ago now. It's an old screenshot, but it doesn't really matter. What I want you to look at here is some Forex pairs. There's the FTSE 100 index as well. There's some trades that I've done. Say it's an old screenshot, but it doesn't matter. So Swiss yen trading at £9 per point. There was the opening price, and there was the closing price. That's a 40 pip profit. Okay. There was a buy there on Aussie yen, so 84.89 to 85.29. That is also a 40 pip profit. Okay, and trading it at those sizes, I was able to make those pounds profit from those particular trades. The point about this is relatively consistent, that the difference between the entry and the exit is usually quite small, and that's what I liken to scalping. So a lot of people who trade end of day charts, they think that the way in which you make money from it is by taking 5, 6, 700 point moves. It actually really isn't. It's a very frustrating way to trade in many ways. A lot of the time you end up stuck in trades. You end up having to trade with very wide stop losses. You have to water down your trade size, because if you're stuck in a trade for 3 weeks, then you don't want to just have one trade on, because that's all your capital just in one trade. That's not going to give you the opportunity to make much money. So what you want to do is have the several concurrent trades on, so more positions open, which means you've got to trade smaller size and so on. It actually makes it more and more problematic. It doesn't have to be this way if you understand how these markets actually normally work. You see, thing about most traders is that as I said, they think the markets typically move 4, 5, 600 points on a decent move, but they actually don't, and it isn't really where the money is, believe it or not. The money is over frequency, and the money is over an understanding of how markets typically move. So that's something that we want to go and talk about today. So what we're going to talk about is, we'll look at some indices today, but we're going to talk about trading the right types of markets. I like Forex because it's very accessible. I don't trade the, things like, I don't know, South African rands and stuff like that. I'm not interested in that because the spreads are very wide. The dealing costs are very wide. So I focus on the more liquid currency pairs, so one against another. So euro against a pound, euro against a yen, New Zealand dollar against the Canadian dollar, and so on. So these are the rather more liquid markets that have good, attractive dealing spreads. What I also look at is being in trades for between 1 and 3 days. My average hold time on this strategy is 1.4 days. Okay, so typically I'm not in trades for that long. Faster indicator settings, I'm looking to be in and out quite quickly. So whilst we have end of day trading strategies here, we have the D1 sniper strategy for Forex, and we have the D1 accelerator strategy for Forex. Well, for indices, Forex, and commodities. But on the D1 accelerator strategy, which I'm going to focus on today, is quicker. So the indicators are on a faster setting, so allows us to get into trades earlier, which then allows us to get out of trades earlier. A little bit like raiding the market before it even knows we're there. That's the sort of thing that we're looking to do. Little cat burglars, basically, looking at 30, 40, 50 points out of the market, and I'm going to explain why in just a second. That gives us the ability to, if we're entering trades earlier, that gives us tighter stop losses, right? It's a great way of doing it. And because we can have tighter stop losses, it means we can have tighter targets. And tighter targets mean we're going to be out of trades more quickly, even better. Okay, and we're going to be looking at a momentum type of trading strategy. Let me just explain something here. If I just look at some charts here, this is a chart for the DAX, and I think this will probably actually demonstrate it quite well in this step if I do this now. So this is a chart over the last, I don't know, few months or whatever. Okay, so if I just bring it up to date, whatever it is. So the DAX index, this is a daily chart. There it is, the GER40, it's the daily chart, it's the D1 accelerator strategy that we're looking at here. What you can see is a series of red and green lines. You can see a disk. Now, these disks effectively mark out our high probability setups. These are our potential trading opportunities. Now, I'm not going to get too bogged down into what's behind these in this case, because I just don't have time today. If you want to look at other workshops that we do, you want to attend one of our training events, and so on, you can do that. We have webinars all the time that go through more about these strategies. I'm not going to do that today. What I'm going to do is talk about how we take these high probability entries and how we look to trade them. Okay. What I want you to notice is that actually over this period, it's actually quite a choppy market. Now, for a lot of us, a lot of newer traders, we think that the markets typically move with big sweeping moves like this. And this is a move from what, 14,500 down to say 13,000. That's a move of about 1,500 pips. Okay, that's DAX is quite a fast market. That would equate to probably 500-point move on a currency pair. That's a very, very, very big move. It is also very, very, very unusual. And the thing about a lot of traders is they trade on the expectation that the unusual is likely to happen. It's a bit odd, isn't it? Sometimes we're looking at these big moves of 400 or 500 points. That's what we should be making on a trade. No, it isn't, because it doesn't happen very often. You look at the way this chart is actually moving. Well, let me explain. So if I showed you each of these sniper discs, so that's a trade. That's a sell trade number 1, 2. I'm not going to mark all of these out but number 4, that's a green. That's a buying trade. The question is, how far do these markets move after the opportunity. What does a typical rotation look like? Is it 500 points, 1,000 points, 1,500 points, or is it considerably less than that? Well, actually, that's day one, that's day two. This market only fell for 2 days before rallying, and rallying quite aggressively, by the way. That's quite normal. This market here, there was an entry there for a sell trade on the close of the bar relative to the sniper disc. This market fell for 1-2 days, hit the low, and then reversed on a sixpence. 2 days fall. This was a 1 day fall. Okay, it was a loss-making trade as well, by the way. This market rose for 2 days. This market rose for 1 day. This one fell for, let's call it 8 days. It doesn't really matter what it is. It's a bit more. This market, there's a sell trade there. Okay, the sniper disc giving us a sell. There's the entry there. This market fell for 1 day. This sniper trade here, so there's no buy trade there. That's fine. The software avoided that one, which was good. And then there's another move down there for, let's say, 4 days. This gives us a move down for 1 day. This gives a move up for 2 days. This gives a move up for, I don't know, 5 days. Move down for 1 day. Move up for 3 days. Move down for 4 days. Okay. The point I'm trying to make with this is that an 8-day fall is, well, it's only happened once. Okay. What is the more normal scenario here? The more normal scenario is probably a 2-day fall. And the reason why a lot of traders lose money is because they don't acknowledge this. And a lot of them don't acknowledge this because they don't know this. And they don't know this because they haven't done this data analysis and analyzed the charts. Maybe, I don't really know. The point is that's what the markets typically do. And so your strategy really should be based on what the markets typically do, unless, of course, the payout for being on what it doesn't typically do is significantly higher, but it isn't. So what we should be doing is looking at, well, how much should this market move over, say, 2 days? That's what we should be looking at, or even 1 day. We should be looking at what is the sweet spot. And if we're going to be getting in and out of the market quickly, like raiding the market for a brief period of time, then we need to have an understanding of the most likely scenario for a move. It's not 4 or 5 days. That doesn't happen very often. What does happen very often is a move for 1 or 2 days. And if we're able to make profit out of a market moving for just 1 or 2 days, then do you know what that does? We get in, we get out, that frees our capital up again to move to the next market that's then moving. And it may not be the DAX like it is here. Maybe it's euro dollar, maybe it's dollar yen. It doesn't really matter what it is. The point is our capital is free. We've taken our pound of flesh out of the market. We've done what we expected the market to do. Sure, we might have got out of the trade here and we've missed all of this, but that doesn't matter because in the main, on the vast majority of trades, let's say you got out here, you got out a pretty good exit. You're never going to get every pip anyway, right? So we shouldn't think about that. As the market then reversed, it could have ended up being a loss-making trade. But not if you are setting your target at the right place and acknowledging how far a typical trade is likely to move. Okay, and this is down to a deeper understanding of the markets, which again, a lot of traders, a lot of new traders just do not have. Guys, again, can I get a yes or no, guys? Is this making sense so far? I look at charts like, there's a really good example of one actually the other day I was looking at. Where are we? We'll just quickly go to Euro Swiss. Was it Euro Swiss? No, it's CAD Swiss. There are times when markets move and flow beautifully. Like here. Real beautiful, fluid, lovely moves. Very straightforward. If only it was always like that. It isn't. So what we have to do is harmonize with what the market delivers for us. And that is usually a more erratic market. We have to acknowledge that. And if we don't acknowledge that, it means that if our stops are too tight, we're just going to get chopped out and we're going to have to trade super low size and blah, 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 blah. So this is what it is, okay? But the good news is there is a significant potential for profit out of this. And if I just go back to the DAX, if I look at this particular set of opportunities, all of these should be winning trades for anybody who's using our system, apart from this one and this one. These are like 2 loss-making trades here. It's fine. It's normal. You're going to have loss-making trades. Deal with it. Okay. But the rest of them are really nice, profitable opportunities because the rest of them move at least like 200 points, at least. So there's significant profit potential in all of these. It's just a question of understanding what the markets are likely to do. So let's just go back to the slides for a little bit. We'll talk a bit more later. But say for me, this is about getting in the position for growth. It's about an understanding of what the markets do so that we can adapt our strategy to that. The D1 Accelerator strategy, these are the latest results, bang up to date. Since December 2019, it's up nearly 27,000 pips, and that's month by month results there. Now that's using 100% rules-based entries, and then an exit strategy, which obviously we teach you through our coaching programs and our workshops and so on. But you can see some significant profit potential. That's just looking at Forex. So that chart for the DAX is not included in these results simply because with the DAX, with indices, they tend to distort the numbers a little bit because they're much bigger movers. So instead of looking for 30, 40, 50, 60, 70 points on Forex, you're looking like 200-300 points on indices, which can then just have a big weight on the number of pips there, so it ends up getting a bit sort of confused, really, in my opinion. So this is just nice and clean, just on Forex, which people can do really easily on any trading account, really. So what is it looking for? What are we doing? Well, I've given you an idea about how these markets work. Markets typically work in little boosts of speed, usually around sort of 3 or 4 days. Okay, so whenever you look at a chart here, I've got a chart here of euro dollar on the left, pound yen on the right. The reason I've got those in there is just actually because there's no correlation between them. So it's not euro dollar and pound dollar, which are going to move similarly often. These are relatively independent. What I've also done is marked out dates on this. Now, this is again a little bit old, but it doesn't matter because it just explains it quite well. So there's dates like the 5th of August, 13th of August, 28th of August, and so on. What you'll typically find on any chart is you get a little burst of speed for 2 or 3 days, then it will stop and then reverse the other way. So like the elastic band becomes stretched after 2 or 3 days, and then it has to give back again. Then it stretches again, gives back, stretches again, gives back, stretches again, gives back. Look like I'm playing the accordion. So what happens is decent move here, back. Decent move and big move down, big move up, big move down, big move up, and so on. That's the way the markets move. Occasionally you get these big blowout moves, but they're not that often. What's interesting about this is if we have the ability to capture that, then we have the ability to take profit and then move on. So for example, had we have taken this trade on the 5th of August, we've got that nice little boost of speed. We take 50 pips out of it, for example, and then we're out before the market starts to pull back the other way. So again, we've cat burgled it, we've taken the money, and then we're out. I don't care what it does after that point because it's done what I expected it to do. It wasn't a sell trade because it didn't meet the right hallmarks for it, but we then get a buy. Buy number 2, that's on the 13th of August. What did the market do? Had a really nice rally for 2 or 3 days. Good. It hit our pound of flesh, we took our profit on it, and we took the money and got out. Okay? And then we're waiting for the right setups. That's what the snipers do. They identify for us the opportunities, the turning points that have the highest probability of making profit, the highest probability of generating a profitable opportunity for us. Okay? So again, we have another one here. Rallies for 2 days, and then bosh, off it goes. Okay? Again, down it goes, and again, up it goes. Nice and clear, nice trading opportunities. What you'll find from this is that the bursts of speed that you get on a market like euro dollar will not align perfectly with the bursts of speed you get on pound yen. What that means is, whilst euro yen is producing a good opportunity, pound yen might not be. There might not be anything to trade. But by the time you've closed out of euro dollar, actually, there might be something going on with pound yen now. So as what we're looking to do here to generate profit, what we really need to be is using our capital wisely, which means allocating capital from one solid opportunity to another rather than being stuck in it. This is what we established earlier. That is the scalping mentality. So I'm going from one opportunity to the next, to the next, to the next, rather than hoarding lots of open trades together. This is the way in which the markets move. So for example, on the 29th of July, we get in the trade, we're out within a couple of days. Okay, then we're in this trade on euro dollar. In on the 5th of August, we're out within a couple of days. Oh, look, the 11th of August is a buy trade here. we're out within 2 days. 13th of August, we're out. Oh, look, end of the 13th of August, we've got a buy trade. We're switching our capital, if you like, from pound yen. We've closed it, we've taken our profit. The capital then becomes available as margin on our spread betting account, our CFD account. And then, oh, look, there's a high probability setup on euro dollar. Great, let's trade that. And then, oh, look, we're out of that after a couple of days. Look, there's one on the 20th of August there. That's a loss-making trade, but it doesn't matter, and so on. What you're doing is you're building the opportunities, and you're able to switch from one market to the other rather than holding and holding and holding trades ad infinitum that don't really go anywhere. Because within this chop, there is significant opportunity to trade within it, as long as we understand it and where those opportunities are. And actually, if you kind of line them up, it's actually really relatively difficult to do this. But you've kind of got there 29th of July, 5th, 11th, 13th, 20th, 21st, 28th, 16th. Oh, look, we're out on the 17th, out day one. 17th, you're out. Oh, look, there's another trade on the 9th, 18th. Brilliant. Okay. And then hold it for a couple of days. 25th of September, next trade. Oh, look, then we're out to the 29th. So you can obviously look at lots of different markets, but this is two that just works quite nicely for this example and gives us the ability to be nimble and move from movement to the other. So effectively, we're not really trading the markets per se. What we're doing is we're trading the opportunity of movement. Where that movement is, we're just looking to be nimble to isolate that movement. That's what the sniper does, and then to be able to trade it. Okay. So again, guys, does this make sense? Give us a quick yes or no in the questions box. This is really just about what this strategy is there to achieve. Okay, and I suppose really what it isn't there to achieve, really, in many ways. I think again that often when people look at the markets, it's about, oh God, I need to, only took 50 pips out of that trade. That's rubbish. It's not. It really isn't. It's just sometimes, I think a lot of people, when you've watched a few videos on YouTube, you've learned how to do something in a particular way, think, oh, that's the way to do it. But a lot of these things are common conventional wisdom, but common convention doesn't necessarily work. And in fact, if it did, then there wouldn't be 90% of traders losing, would there? Very often it's, certain what sounds good in theory isn't actually what works correctly in practice. And again, a lot of it is down to that real sort of solid understanding of what the markets are most likely to do. Really. So there's a significant amount of reason why we do things in the way in which we do. So look, let's have a look at a few opportunities. We'll look at some Forex and then we'll move on. So there's a scanner tool here. We'll look at the D1 Accelerator and we'll look for trades over the last 3 days. Hit search. What we basically got on the scan here is opportunities that set up 3 days ago, marked with a 3. And then these are opportunities that are setting up today, opportunities that set up yesterday, for example. Guy, can you definitely say that this software recognizes where and why the specific market will turn? No, what the software does is it recognizes when a market is turning based on the conditions that we have set. Okay, will that lead to a profitable opportunity? No idea. We don't know. All we can do is look at what those turns, what those patterns have produced in the past to identify what it is likely to produce in the future. So, for example, all of these turning points marked by the snipers are patterns that have they're the repetition of patterns that have historically produced very high probability trading opportunities. Okay, it is a repetition of that pattern. So, oh look, that is repeating itself, that pattern's re-emerged, and it is a turning point that is likely, all other things being equal, to drive the market further from there. Okay, and then in terms of where that is, well, we look to enter on the close of a candlestick. Why there? Because that's when the indicators, like any indicators, whatever time frame you're trading off, that's when those indicators are locked in and confirmed. Okay. If you are in a trade going the right direction, can you put 3 or 4 trades on at the same time? Do you mean different markets, Ken Lloyd, or do you mean in the same market? Just put D or S for different or the same. So what you have here with this scan is a series of opportunities setting up at that particular time. Okay, so Ken's put a question here. If you are in a trade going in the right direction, can you put 3 or 4 trades on the same trade? You can do whatever you like, Ken, but I wouldn't. What you're doing there is if you're in a trade, okay, and it's going the right way, you're going to be adding to the position as it continues to fall. But in this particular strategy, if you're recognizing that it's most likely to only go a short distance, then actually there's no point really adding to it, because by the time you've added to it, it's probably done what it's supposed to achieve, and therefore all you're going to do is add to it on its lows or add to it on its most likely highs, in which case you're going to be adding risk and adding loss-making trades. You're going to be snatching defeat from the jaws of victory. Really. So this is the difference between a scalping strategy and the one that maybe looks at 500 to 1,000 points or something like that. So I think adding to a trade is probably a bad idea. If you're adding to a trade because it is losing and starting going the wrong way, that's even worse. That's definitely the not thing to do, because all you're doing is adding to something that's already going the wrong direction. It's a bit like placing more bets on a horse that's already losing the race. You backed it at the start. It's after 50 meters, it's last. Okay, all right, it's good, better value now, better odds now. Let's back it. Okay, after half a mile, it's still last. Okay, let's back it again. After 3 miles, it's still last, and it's only half a mile left to go. It's probably going to come last. It's the desire to add to losing positions is difficult. Could you have different positions on? Could you trade euro dollar and pound yen and a couple other positions? Yes, I'd diversify my risk and add to my opportunity that way, rather than just loading all in on one particular trade. Ken, I don't think that's a good thing. Does the turning point get marked after the start of the turn then? So what happens is, well, I'll show you actually. I'll show you like Aussie Swiss here. Actually, that's not a sniper one. So look, let's find one with a sniper on it. There isn't one there. Okay. So, Guy, what's happening here is that there is a sniper on today's bar for euro against the New Zealand dollar. Okay, so effectively one of our USPs is that we're identifying a high probability turning point there. That's what the sniper's doing, and it's a repetition of a high probability pattern. So a pattern that's previously produced fantastic trades is repeating itself today. Okay, so you got a sniper on today's bar. Now this is an end of day trading strategy, so we wouldn't be looking to place this trade at 7 minutes past 1 or 8 minutes past 1 as it is now. We'd be looking at doing it this evening. So it's giving us a warning sign at this point, because we'll be saying, oh, looks like a sell trade and why and so on. It's stuff for a different session really, but effectively it's telling you that it's looking pretty juicy. It looks like a decent pattern. It's repeating itself. You might want to have a look at it and potentially trade it tonight. That's basically what it's doing, Guy. Does that make sense? The idea being that from the close it should then carry on and go a bit further down. Obviously, if the market's going to get down here, it's got to go down there first. You know what I mean? In order to go from there to there, expecting lower prices. So it gives us the opportunity to capture a proportion of that move. Okay. Good. Good questions, everybody. We like questions. Okay, so look, so that's Euro New Zealand. That's the sort of thing that, again, that we're looking for. Little bursts of speed, 2 or 3 days. It's not always going to be bang on accurate, because nothing ever is. You can't be. But let's have a look at some of these from the scan from yesterday. So we had euro against the Australian dollar, and you can see the types of opportunities that we've got there. Okay, so you can see the nice buy trade, sell trade, buy trade, sell trade. So you've got a sell trade that's kicked in there from euro against the Australian dollar. How you then trade that, what sort of move you look to capture? Well, there is a tool that you can use with this system that can help you to capture that as well. So we have these starter targets. You have bigger targets, extended ones that just require a bit more of a discretionary overlay, but the starter targets you can apply, and I can give you an objective down to 143.98. What's the market got down to? not quite that low yet, so we're still open on that trade at 144.05. It's been down to today. That gives you a likely scenario for that opportunity. So the scalp, the objective where we think this should go, is down to 143.98 for the euro against the Australian dollar, and that's based on the setup that we have here, and it's based on the way in which euro against the Australian dollar typically moves. So we look at what the system does is it looks at the best performing and most consistently performing patterns, but also how far those patterns will typically move, so that we can capture the likely scenario. So that's Euro Aussie. Euro Yen, you can see similarly here. Some really nice trading opportunities, and again you can see here there was a sell trade, so that was triggered last night. Okay, so that's Monday evening. You've got the opportunity there. This is what our members were doing. They're running their starter targets and so on, so you've got an opportunity there for a target down to 136.27, and the market's just a little bit higher than that now, but it's gone through that objective. It's achieved our pound of flesh, as it were, and now the market's, it can do what it's going to do now. It's done that scalp. Okay, so the scalp distance in this case was what, I don't know, 40, 50 points, whatever it was. It gives us that opportunity there to take it. So 40 points, you do that at £3 a point, that's 120 quid on that opportunity. And my guess is this is probably only in for a few hours, but it's only looking at the markets at once a day for those entry points. So you've got an entry point there, which was triggered last night. It means that actually you can position this around your day-to-day lifestyle, knowing that you're looking to capture that bite-sized move, get in, get out, move on for the next opportunity. So what's happened here is with Euro Yen, we allocated some of our capital to it by entering the trade yesterday. When that trade was closed out, it achieved that target. That capital becomes free, doesn't it? It's now becomes available that we can then look to place maybe a new opportunity tonight. Okay. What we can then look at is what else have we got here? So pound against the Australian dollar. Again, similarly identifying those trades. You can see that one from a few days ago. You can see that one from yesterday. Again, they're there to identify these scenarios for those markets. And again, it doesn't have to be that big. Sometimes we're only looking for little bite-sized moves, 40, 50 points, which is that little scalp, in, out, moving on to the next one. Okay. Reward to risk, yeah, around that sort of 1-to-1 very often, I would say. But again, actually, very often the way I look at it is that we're usually backing the favourite here, the most, the most likely scenario. So if you're going to back, say, Manchester City to win a game, you probably don't mind, getting less than even money on it, because it's probably quite highly likely to win. And trading can be like that as well. There's some trades, it's like, wow, this is just a gift, and sometimes you are effectively, backing the favorite there. So there shouldn't really be too much of an issue with that if the reward is slightly lower than the risk, I would say. Again, sometimes, with common convention, there are ways in which people read things, and, so some guy who's probably never traded before, he says, oh yes, you should always look at 3-to-1 trades. Your objective should be 3 times your stop loss distance, because that's the way you should do it according to the textbook. And then that looks out very clever when you compound that account, it looks wonderful and blah blah blah. Fine. So everyone's following that. If everyone is doing that, 2-to-1s, 3-to-1s, and so on, great. So why does everyone lose money then? Why 90% of traders lose money, 80% traders, whatever it is? Maybe it's because that doesn't work. Maybe it's because the stop loss and target needs to be where it needs to be, and that's based on whatever it's telling you at the time. And sometimes I'm actually happy to accept, maybe I've got a 50-point target, but I've got an 80-point stop. Am I bothered by that? No, not really. I'm not bothered by it at all, actually, as it goes, because my success rate over time and with this strategy has been well in excess of 70%. So I'm pretty happy with it. Pound yen. Here, again, you can look at it on the same sort of basis. Again, the market's giving us that little oomph of move, and we take it out there. Okay, so nice move, and so on. 161.21. The market's now trading at 161.63. This is actually a really classic example. I don't know what's going to happen here next on pound against the yen. What I do know is that we got our entry there. Our target is at 161.21, which is about here. So the market has hit our objective. It's gone down there. It's gone a little bit through it, and then it's bounced. It's back up to here. We're now broadly break even. So some people might have moved their stop loss to break even. They've now lost or had a break even trade, which is really annoying. But having the target in the right place, we're out. Our account's a little bit higher than it was before. We can draw that down. We can take profits. We can withdraw our profits. We can go and buy something. We can go and keep it in our account. We can trade bigger size the next time. We can do what we want with it, really. The point is, the market did what we expected it to do. It's then rallied, which is also what we expected it to do, and we've taken a little bit out of it. Okay. Without the stress of being in a trade for, massive moves. Because if you wanted to be, let's say you took a buy trade here, I mean, there's no buy trade there, but let's say you did, in order to get the 500-point move, which is up to, well, what is it up to? The 500-point move, that's up to 169. That's got to go up to here. So within that move, it's probably going to go way, all these size of these moves before it eventually maybe gets there. It probably doesn't get there anyway. But even if it did, the stress that's associated with it getting there is way higher than the stress of being in and out and taking the move and moving on. Okay, and a lot of this really should be is like, how can I manage my week? How can I manage my month so that I can achieve my trading goal? Because each month you want to be in a better position than last month, right? And actually, the more in control over the trades you are with those stops and targets, the more in control you have over your end of month goal. If you're looking for those big targets, you end up really with either a very good month or a very crap month. And you're making big losses and so on. If the markets are choppier, your equity curve, your volatility in your performance becomes a lot higher. So you can smooth that down by taking fewer trades, more higher probability, smaller trades, if you know what I mean. Hopefully this makes sense. Does this make sense? Let us know. Give us a quick yes or no. Is this making sense, guys? Let me know in that questions box, please. I'm not going to be on for too much longer. I think I've probably gone a little bit really, but I do like to go through these things where I can. So that's pound yen, pound New Zealand. Here, that's a similar move, right? You look at the move there, that had a 1-day rise. This one's had, well, it's gone back to break even again. So the fall from 190.50 down to 189.70, it's fallen, 70, 80 points. That's good. It's fine. It's done what we expected it to do. It's a pretty decent, profitable opportunity. Thanks very much. What it does afterwards, I don't actually care. Whereas if you're looking for a 500-point trade, if you're looking for a massive winner here, what you're doing is looking at a trade that was going really nicely this morning, and now you're thinking, oh God, actually, it's not looking very good now. What do I do with it now? I'll probably close it out now just to make myself feel better. The emotions associated with it become significantly higher the longer you're in trades, and the more room you have to give it to breathe. UK 100. Fantastic. Look at that sell trade there. Absolute textbook on the FTSE. That's fallen, 50, 60 points or so. And even the Dow, it's a bit of a bigger move, really. You can expect that on the Dow. It's fallen, 600 points or so from its entry, but really nice and clear. Okay. Show us a couple of stop loss levels. Well, look, let's have a look at this one on the Dow. From the stop loss on there. That's a big stop, obviously, because it's the Dow. That's about a 300-point stop, just a bit more, 330 points maybe, something like that. If I look back at sterling New Zealand as an example, then we've got an entry there from 90.56. You could put the stop in there. It's about a 60-point stop on this particular example guy. Some will be wider. So this one here, 190.50, the stop loss there. That's about 120. You can go for a bigger target if you want to, but it's a bigger stop. And that's because the entry bar is pretty strong. What's interesting about a strong entry bar is often it means that the risk reward's a little bit lower, but actually it usually means that the market's got some real oomph behind it. It's like it's already started out the gate really fast. It's like a sprinter that's already winning after the first 10 meters. And now you're looking for it to continue the speed in which it's there. So the momentum is with it. Again, I don't particularly mind that. But it gives you an idea. A lot of them, Pound New Zealand is one of the fastest moving currency pairs, by the way. So the stops are going to be wider on Pound New Zealand than they might be on an Aussie Swiss or something like that. So for example, the stop on this one, what are we looking at? About 30. Okay, so that buy on Aussie Swiss, about 30 points I'd be putting in. Okay, gives you some idea, I think. Good, guys. That's going to be pretty much it from me. What I'm going to do is just make a quick point that there's a few things that we do here. We help teach people to trade forex, indices, commodities with our Trend Signal Plus course. We've got a stocks program, we've got a cryptocurrency program, and we've also got a very short-term day trading program as well. If that is something that suits you, day trading. So like I said today, it's not for everybody, but those that it is for that have more time, then day trading might be a great thing. That's called the dynamic trader strategy. Whatever it is, if you're interested in trading, you're looking for a system and strategies that can help you trade with that great framework from which you can build, then please do get in touch. You've got our contact details here. Today is really a little bit of a taster of some of the things that we do, the way in which we go about it to help us to identify high probability trades. I hope you found it useful, and I hope it's something that might help you to have the confidence to join Trend Signal and enroll on one of our training programs and use our systems. So otherwise, guys, all the best. Wish you every success with your trading, and hopefully we'll see you in a workshop soon enough. If you're interested in our courses, go to our website, trend-signal.com, get in touch with us, follow us on Facebook, YouTube, Instagram, Twitter, whatever it may be. We're all there, and you can keep in touch with various recordings and sessions and tidbits and whatever else it may be about trading. All the best, guys. Thanks. Bye-bye for now.